Hi everyone, Matt from Stock Trades here. I hope that you're all keeping safe and finding a way to remain upbeat during what is, I'm sure, a very difficult and strange time for the majority of us. For today's video, we want to focus on a sector that is doing quite well during this bear market. And it's not one that you might expect. We'll finish off the video by introducing you to 3 tech stocks that are performing quite well and are outperforming the index. They also have a good chance of outperforming moving forward. So with that in mind, let's get to it. When the markets first crashed, everything cratered. All sectors, no one was immune. However, the tech sector has been one of the first to rebound. In fact, it is now in positive territory. Year to date, as of filming, the S&P TSX Composite Index, which is the benchmark index for the Canadian markets, has lost approximately 16% of its value. In comparison, the S&P TSX Technology Index is actually up 11% year to date. That means that it is more than doubling the performance of the TSX. So, which stocks stand out? Which stocks have outperformed the index? Let's take a look at our first stock, Kinaxis. Before we get into the nuts and bolts, I first wanted to just give you a little rundown of what Kinaxis does. Often when I find with these tech companies, individuals aren't necessarily up to speed as to what they do. So Kinaxis is a leading provider of cloud-based software as a service solutions, specializing in supply chain management. You might actually hear the term software as a service. That's SaaS. It's well-known, cloud-based, and it's really an area of high growth right now. So as you can imagine, in this environment where borders are shut, there's limited travel between provinces, even borders with the United States are on lockdown, it must be very difficult for organizations to manage the supply chain. There has been a huge shift to globalization over the past decade or so, maybe even going out spanning 2 decades. Now, with everything on lockdown, companies are realizing just how complex the supply chain management is. So they are looking to tech companies like Kinaxis to help solve issues with improved software, improved programs, and improved data analytics. So it's not surprising that Kinaxis has benefited. They are looking to Kinaxis to help them navigate complex environments. And the need, quite frankly, has been exacerbated due to COVID-19 mitigation efforts. Over the past 5 years, revenue at Kinaxis has more than doubled. It has gone from approximately $91 million to $191 million as of end of 2019. This is a compound annual growth rate of approximately 16%. That's an impressive rate, and a rate you're not going to find in many stocks. Analysts also expect the company to perform just as well over the next 5 years. In fact, they have a targeted annual growth rate of 16% over the next 5 years, which really matches what they've done over the past 5 years. So you might be looking at the same type of outperformance from a company like Kinaxis. Now that being said, the company right now isn't cheap. In fact, it's one of the most expensive tech companies on the TSX index. It is trading at 80 times forward earnings and has a price to sales ratio of approximately 17. This puts it at the high level with respect to tech companies and software companies in particular. It has been hitting 52-week highs. Year to date, it's up 22%. So it's far outperforming the markets, and it's even doubling the performance of the broader technology sector index. In our opinion, we would not rush out and buy Kinaxis at these levels. It's definitely a little rich for our taste. However, that's not to say that it won't outperform over the next 5 years. The company is well positioned, has a great product, and there is an increased demand for their services. In our opinion, it's a buy the dip candidate. Speaking of which, let's head into our second stock, Shopify. Arguably, there has been no better stock to own on the TSX index than Shopify over the past 5 years. The company IPO'd in 2015, and since its IPO, the company has returned 2,560%. That means that a $10,000 investment in the company would be worth approximately $266,000 today. That is an impressive growth rate, and you won't find that among many other stocks on the TSX index. Since its IPO, it has consistently ranked in the top 5 best performing stocks of the year. In my time watching the company, I've noticed that Shopify makes big moves. It will move by double digits, high as 20% sometimes. After earnings, at one point there was a notable short seller that was following the company. They have since thrown in the towel. But whenever there's news out around Shopify, it tends to move and move in a big way. In my opinion, Shopify is one to look at anytime it dips by 20% or more. That is a time where you might want to take a deeper dive into the stock, look at it, and see if it might be time to start accumulating some shares. As an aside, this is a good time to point out that our Stock Trades premium platform is based on evaluating growth stocks. And Shopify has often found itself in the top 20 of our screener. It usually moves up and out of our screener depending on the price that the company is trading at. So for those interested, you can sign up to Stock Trades Premium for free. You can actually sign up using the link below. It'll give you a taste of what our Stock Trades Premium platform is all about. And then you'll be offered the opportunity to upgrade to our premium version at a 40% discount. We do this because we have high confidence in our product. Not only that, we give you a 30-day guarantee. So you can try it. If you don't like it, we'll offer you a full refund. So with that being said, check out the link in the description. If you have any questions, feel free to shoot us an email or throw it in the comments below. So back to Shopify. As mentioned, one of the knacks is that it's expensive and doesn't turn a profit. And one of the stocks it's often compared to is Amazon. If anyone has followed the markets for some time, they'll know that Amazon faced the same critics. It wasn't profitable and it was highly expensive. Look at where it is today. Shopify is following those same patterns. It is definitely one that you want to keep on your radar for when it dips. Now, if Shopify and Kinaxis are too expensive for your taste and you just can't bring yourself to buy a company at such high valuations, we have another stock for you, OpenText. OpenText has performed quite well over the past number of years. It offers a wide range of cloud-based solutions, from enterprise management to customer service experiences, data analytics, cybersecurity. I could go on. Bottom line, they have their hands in many different areas. How did it get there? The company is a serial acquirer. This means that it often makes multiple acquisitions in any given year. Management has an excellent track record of integrating these companies into the fold and improving operations and increasing sales. Now, OpenText is attractive for a number of reasons. First and foremost, the company is cheap. It is trading at only 14.5 times forward earnings and only 3.71 times sales. This is among the bottom of all TSX tech-listed companies. So it's cheap. Actually, it doesn't matter what metric you use. OpenText is usually near the bottom with respect to valuation. One of the reasons why it finds itself at the bottom is because it has underperformed. Year to date, it is down approximately 3%. Now, this is way better than the TSX index, which has lost 16% as discussed earlier. However, it underperforms the broader tech index. The good news is that since OpenText has underperformed in relation to the tech index, it's now a good time to accumulate. It's cheap and provides good value. The second reason why OpenText makes a good investment is because it pays a dividend. Not many tech companies pay a dividend. In fact, there are only 3 Canadian dividend aristocrats. Those are companies that have grown the dividend for 5 or more consecutive years. OpenText is one of them. It has a 7-year dividend growth streak, over which time it has averaged 15% annual dividend growth. I have 2 portfolios. A dividend growth portfolio, which accounts for approximately 80% of my assets. And then I have another 20% of my portfolio, which is just growth stocks. Shopify, as mentioned previously, I hold that in my growth portfolio. I am also a long-term shareholder of OpenText. For dividend growth, there aren't many options in the tech industry. Usually you have to look south of the border. There you have companies like Apple, Qualcomm, Intel, Microsoft, all make for excellent dividend growth stocks. In Canada, however, there aren't too many dividend-paying tech stocks. Luckily, OpenText makes for an excellent choice for investors. And that brings us to the end of our video. We need to look at tech in a complete different way. It's no longer only for those with a high risk tolerance. Defensive and conservative investors must have tech exposure. If you didn't have tech exposure over the past 10 years, you would have missed out on some pretty significant gains. Tech is an essential service. We live in a world that is more and more connected. Whether it be Shopify, Kinaxis, or OpenText, there are several different options for you. The Canadian tech landscape is changing. There are more and more options for investors. It's important for you to gain exposure. And that's it for today. Please like, subscribe, post your comments below. We'd love to hear from you. What tech stocks are you invested in? Till next time.